Have you been recommended a systematic withdrawal plan by your advisor? Well, we're going to take a look at some of the pitfalls of that plan in episode 86 of the Atlas Annuity podcast. Hi, everyone. This is Marty Becker, owner and founder of Atlas Financial Strategies in St. Louis, Missouri, where we specialize in safe money retirement strategies. Now, what is a systematic withdrawal plan or an SWP? Well, it really goes back to that 4% rule. Now, for any of you who have heard this podcast before, I've talked about this a lot. The 4% rule was never meant to be the rule. It was basically just an estimate in the early 90s that William Benjamin came up with based on historical data. The economists who study retirement planning, and yes, there are people who do that full time, all of them pretty much agree that 4% is going to be too high. And you can read article after article from Morningstar and all these different financial publications that are suggesting that a 3 or 3.5% withdrawal rate based on your retirement age and longevity projections, that's going to be more of a consistent and safer percentage that you can take. The main thing is that there are two phases to your financial life. The first one is accumulation. And most advisors are really good at this. This is the part where you're working and saving and investing and you're building up the nest egg for retirement. But then phase two is the distribution phase. And this is a totally different set of skills and a totally different set of products to ensure that your money will last as long as you do. And most advisors are terrible at this because it's just a different skill set and they're so focused on the accumulation part. They tend to continue that same mindset after someone crosses into retirement. So you need an advisor that's going to know the difference. And let me give you an analogy here. Let's say you've spent your entire life in America and you celebrate 4th of July and you eat copious amounts of red meat and you drink Budweiser and you complain about your neighbor's yard. Totally American. But one day you wake up in Austria. You don't speak the language, you don't know the customs, you don't know the holidays, and you don't know where anything is. Wouldn't it be beneficial if you had a guide or a friend or an advisor who has been there or is very familiar with the language, with the customs, and they know where to find things? That is very much analogous to moving from working during the accumulation to retiring into distribution. Big difference. And the main thing is that ROI during the accumulation phase has always stood for return on investment. Once you cross that threshold, ROI now needs to stand for reliability of income because you're always going to need income in retirement. Always. That's never going to change because it's the income that determines your standard of living, not your wealth. And ask any wealthy person that you know of, any business owner. It's all about cash flow. It's not about dollar amounts or piles of money sitting somewhere. It's about how much you have coming through the door every single month. Now, the interesting thing is that there's 3 different types of retirees. Number one, you have the overfunded investor. These are the people who have millions upon millions of dollars, and they really only need to take less than 3% of that portfolio. Or maybe they have pensions and rental real estate. They have other sources of income, meaning they don't really need to touch their other investments. Number 2 is the underfunded investor. Now, not trying to call anybody out here, but I do on occasion get phone calls from people who say, yeah, I need $50,000 a year on top of my Social Security, and I have $350,000 in my IRA. The math doesn't math. That's never going to work. So the advice is go back to work. Find a way to create additional income because you're an underfunded investor. Okay. Doesn't mean you're a bad person. You just don't have enough money to retire. But number 3 is what's called a constrained investor. Now, a constrained investor actually makes up the vast majority of baby boomers. And it doesn't mean that you don't have any savings or you haven't done the right things to prepare for retirement, because technically you could have millions saved. But if your withdrawal rate is going to be over 4%, you're going to be withdrawing too much money out of the portfolio to provide a minimum acceptable lifestyle. So again, it doesn't make you a bad person or you did anything wrong. It's just the amount that you need to take out of it is over the safe limit. I didn't come up with this. I got to give credit where credit is due. Always. This was actually written by a guy named David Mashia. Smart guy. I'm enjoying his material. You should look him up. So, what he talks about is the three biggest concerns in retirement, which is number one, timing, number two, longevity, and number three, inflation. Now, the biggest problem with the systematic withdrawal plan is it really all just depends on luck. It all depends on timing. And if you've been listening to this podcast for any period of time, you've heard me talk about this probably 100 different times. This unlucky timing is also known as the sequence of returns risk. Now, I normally use the scenario going back to the year 2000 because that is the most recent example that we have. But what I never considered until I read Mashia's stuff is that the timing risk, the sequence of returns risk, can actually be measured in quarters, not necessarily even years, but quarters of time instead of the years like I've always talked about. So if we take a look at this chart here, this is interesting. If you're listening to this on podcast, go back to the YouTube channel and pull this up. But we have two people with the same amount of money and withdrew the same amount of money. The only difference is that one of them retired 3 months earlier than the other one. So if we look at Ben here, which is the golden line on the chart, he retired in January of 68. And after a period of time, only had about $200,000 left. Now, if we look at Susan, again, same amount of money, withdrew the same amount of money over the same period of time as Ben, she ended up with almost $1 million. Literally a 3-month difference in the retirement date. The problem is nobody knows when this is going to happen because if the advisor or Ben knew anything about this, do you think he probably would have worked an extra 3 months to possibly have an additional $800,000 more over the long term? Absolutely. But nobody knows. And if you're sitting there thinking, well, Marty, he shouldn't have all his money in stocks anyway, everybody knows that. Yeah, correct. But if you look at the footnote on this chart, this comes from LIMRA, and this portfolio that they're representing here has an asset allocation of 42.5% large company stocks, 17.5% small company stocks, so 60% equities. It also has 40% intermediate term government bonds and is rebalanced annually. This is a 60-40 portfolio. The initial withdrawal amount was $16.86 per month, or a little over 4% per year. After that, the individual retiree withdrew the same dollar amount within each calendar year and adjusted annually for the prior calendar year's inflation rate. The cost of funds was 100 basis points or 1%, which is actually low, to be honest. Most people, 1.5%, 2%, depending on the investments. This is the safe play for most advisors. Diversified portfolio solves all the problems, but the timing is never taken into consideration. And again, this was a 3-month difference on when the withdrawal started. That is amazing. Now, here's another example, which is even more dramatic. Again, two people, same amount of money, same withdrawals. The only difference is Kathy on the bottom here. She retired in October of 1968 and eventually ran out of money to zero. No more money left. But Jerry, on the other hand, who retired 18 months later, he ended up with $2.6 million after the same time frame. Again, very small difference in when the portfolio was activated and money was taken out, but a major difference over the long term. And again, at the end of the day, if anybody knew this, obviously they wouldn't have retired in that time frame. They would have waited. But when it's all said and done, everybody's guessing. Okay? Everybody is guessing. And guessing is not a good retirement strategy. And also, let's take into consideration that maybe Jerry in this scenario and Susan in the last one, maybe they didn't want to end up with 7 figures towards the end of their life. Maybe they wanted to be able to enjoy that money earlier in retirement, but they couldn't because they didn't want to end up like Kathy and Ben with little or no money left over. But because no one can predict the scenarios and how they're going to play out, they have to constrain themselves to a predetermined withdrawal rate. And again, that just doesn't seem like a good retirement plan. Why is this important for everyone watching this video? Especially the people that are watching this in September of 2025. The markets have been really good for a really long time, with the exception of a couple blips during COVID. Now, I subscribe to a financial newsletter from Doman Capital, which is run by a guy named Bert Doman, and he is called every bear market in the past 40 years. Super sharp guy. Now, this is from the latest issue, and he was referring to this VIX chart here and all the short positions that are being held. And for those of you not familiar with a VIX chart, it basically measures the volatility in the marketplace, okay? Without giving away Doman's intellectual property, I'm just going to read you a snippet of his last newsletter that came out on September 1st. Quote, speculators have a very big short position in the VIX, the highest since 2022. This means that most non-professional traders expect the stock market to go higher. The professionals are expecting it to go down. That's why they're shorting it. The non-professionals just think it's just going to keep going up and up. Quote, we don't like the crowds. When the short positions in the VIX reach near records as they are now, it often signals the stock market is near a top before a big decline. The VIX then soars. The last peak in VIX shorts was in late August of 2022. The stock market, the S&P in particular, then plunged 19.3%, and the VIX had a better than an 80% rise, unquote. So Doman seems to think that there's going to be a big decline in the market. But again, no one knows exactly when that will happen. And as we have seen from today's podcast, if your timing is off, even by a few months, it can produce a very different outcome in the long term. So if you are a constrained investor that's been recommended a systematic withdrawal plan, I hate to break it to you, but you're literally gambling. You're guessing. Nobody knows. And the asset managers that come up with these diversified portfolios, the same ones who are really good at the accumulation phase, but don't understand the distribution phase, like a lot of experts out there, they're selling returns. They're not selling guarantees because they're using the products that seek to produce a positive return, but at the same time, they're passing all the risk to the investor. And I don't think it's because they're bad people or they're dumb or anything like that. They're just doing what they've always done and what they've always been taught to do, which is an overfocus and a false confidence on the accumulation-based products. And as stated earlier, it's a different set of skills. It's a different set of products once you move into the distribution phase. And the best way to mitigate timing risk, sequence of returns risk, is just to get rid of it completely. And the best way to do that is with an income annuity, because annuities are not investments. They're insurance. And insurance, by its very nature, is a transfer of risk. So get the risk off your plate. Get it out of your lap. You're not going to drive around in a brand new car without insurance. So why would you let someone drive your retirement account with no insurance and just be totally exposed to all that risk? Because at the end of the day, the people who study this, there's never an argument about the value of an annuity. The argument that ensues is what type of annuity and when to use it. That's what they argue about. You're never going to stop needing the income for retirement. Your lifestyle is determined by your income, not your wealth. The best way to provide income is through an annuity. And that's going to be a different strategy and a different type of annuity and a different time frame for every individual client that I talk to. There is no cookie cutter solution. But what it's going to do is guarantee you income no matter how long you live. And even if you run out of money, you're never going to run out of income. Think of it as a fruit tree in your backyard. You go out and you eat for the day, the fruit is going to replenish itself. And just like with a thermostat in your house, depending on the volatility of the weather, you can keep your home at a very comfortable 70 degrees, no matter if it's 110 outside or if it's -5. So you're getting rid of the volatility of the temperatures in the market that hopefully by this point you've realized you don't want to rely on. So it's going to give you the freedom to spend every month knowing that it's just going to keep being replenished no matter how long you live, every single month. So if you're new to annuities and what I said isn't making a whole lot of sense, let me recommend that you go to atlasannuity.com, click on the video section, watch my video series, 20% more spendable income in retirement. And if you're someone who's been considering annuities and how it might work in your personal strategy, book a short Zoom call at atlasannuity.com or by clicking the schedule a call button in the top right corner of any page of my website and get your questions answered, and we'll figure out if the Atlas annuity strategy is a good fit for you. If you're liking this information, do us a favor, subscribe to the podcast and the YouTube channel, give us a thumbs up, and share the information with someone that you think could benefit from hearing it. As always, I want to thank you for joining me. Again, my name is Marty Becker, wishing you the best in your financial education. We'll catch you in the next episode.